everyone. Welcome back to International Financial Management. Today we move into one of the most practically important topics of the course, which is exchange rate quotations. If you are an importer, exporter, or a company treasurer, or even a student traveling abroad, or an investor with an international exposure, you will need to understand and use exchange rate quotations while carrying out transactions. In this lecture, we will cover direct and indirect quotations, American and European terms, bid and ask rates, and complete rate hierarchy with full numerical examples throughout. Let us begin. Before we go into the details of each quotation method, let us first understand what we mean by the term exchange rate quotation itself. An exchange rate quotation simply means the way one currency is expressed in terms of another currency. That is the core definition. It is not about what drives the exchange rate, not about why the rupee is stronger or weaker today. It is purely about the format in which the rate is stated. For example, if I say USD by INR is 84.50, that is a quotation. If I say $1 by 84.50 rupees, that is also a quotation, but it is in words. The quotation is the language we use to communicate a price between two currencies. Now let us talk about how exchange rates are actually written and read in professional dealing rooms. Because there is a specific convention that every forex professional follows. First, exchange rates are almost always written to 4 decimal places. So, instead of writing GB by USD is equal to 1.55, a dealer writes 1.5545. This 4 decimal place precision matters because in the forex market, even a tiny movement in the 4th decimal place can represent thousands of rupees or dollars when multiplied across large transaction sizes. The only major exception to this 4 decimal place is the Japanese yen. USD by Japanese yen is written to only 2 decimal places. For example, 149.80 yen per USD because the yen itself is a low denomination currency. Second, let us understand the term big figure and pips. In any 4 decimal place quote, the first 2 decimal places together with the whole number form what is called the big figure. The third and the fourth decimal places together are called points or pips. Take the example on the slide where British pound by USD is equal to 1.5545. Here, 1.55 is the big figure. It is the broad level of exchange rate that everyone in the market already knows and taken as given. The 4-5 is the pips. This is the precise part that actually changes from second to second and is what dealers quote, negotiate, and compete on. In a dealing room, a trader would simply say cable at 45, meaning GBP by USD is equal to 1.5545 because everyone knows the big figure. Now we must understand the standard language used in foreign exchange markets. Bank, dealers, and payment systems use ISO 4217 currency codes, which commonly defined currency names for international transactions with 3-letter alphabets and 3-digit numeric codes for currencies. Each currency has a 3-letter code decided by the International Organization for Standardization. ISO 4217 is the standard used for currency codes. Usually, the first 2 letters show the country and the last letter shows the currency name. For example, in USD, US stands for United States and D for dollar, while in INR, the first two letters represent India and the last letter R represents rupee. As you can see in the table, the currency code of pound sterling is GBP, where GBP stands for Great Britain and P stands for pounds, while the numeric code is 826. This standardization is important because it avoids confusion in trading, treasury systems, and international settlements. It ensures unambiguous currency identification in financial transactions and interbank messaging. In a quotation like USD by INR, the first currency is the base currency and the second is the quote or price currency. Now, forex quotations can be divided into two broad systems. The first is American and European quotation. This tells us whether the currency is placed as the base and which is the price, specifically in relation to US dollar. The second is the direct and indirect quotation. This tells us whether we are expressing the rate from a domestic currency's perspective or from foreign currency's perspective. These are not two completely separate systems. They are two different angles of looking at the same pair of currencies. We will now explore each one carefully. Let's begin with the direct quotation. Here is the definition. In a direct quotation, the domestic currency is expressed as the price of one unit of foreign currency. In a direct quotation, the foreign currency is fixed at 1 unit. It is the currency that you are pricing, and the domestic currency is what you are paying. Now, notice the convention in the notation USD by INR. The currency on the left, USD, is the base currency, the one fixed at 1 unit. The currency on the right, INR, is the price currency, that is the one that varies. It is the price. So, from Indian perspective, a direct quote looks like this: USD by INR 84.50. What does this say? It says 1 US dollar, which is the foreign currency, is the base currency and is fixed at 1 unit. $1 cost 84 rupees and 50 paisa in domestic currency. The price currency, which is rupee in this case, tells you how much you have to pay per unit of the base currency. The base currency is the dollar that you are pricing. In India, this is how we quote direct exchange rates. In Japan, it would be USD by Japanese yen is equal to 149.80. Most countries in the world use direct quotations expressing domestic currency as the price of $1. Now let us flip the logic entirely and look at indirect quotations. In an indirect quotation, the relationship is reversed. The foreign currency is expressed as the price of 1 unit of domestic currency. Now the domestic currency is the base and it is fixed at 1, and the foreign currency is the price that varies. From India's perspective, INR by USD is equal to 0.01183. What does this tell us? It says 1 Indian rupee, that is the domestic currency, buys 0.01183 US dollars. In other words, 1 rupee buys approximately 1.183 US cents. Now, here is something important. The direct and indirect quotes are simply reciprocals of each other. Ask yourself, which perspective is more useful? The answer depends on who you are. For an Indian business manager thinking in rupees, the direct quote, that is $1 cost me 84.50 rupees, is more intuitive. Since people usually think in terms of their own currency, direct quotation is easier to understand and use in day-to-day transactions. The UK, New Zealand, Australia, and some other countries traditionally use indirect quotation instead of direct quotations because of historical market conventions. For example, in UK, it is common to quote GBP by USD is equal to 1.27. This means 1 British pound equals 1.27 US dollars. These countries historically viewed their own currency as stronger or primary currency, so they prefer to place it first in the quotation. Old market practice has become a standard practice in global forex market. Now let us understand American terms and European terms. American and European quotations differ in which currency is shown as base currency or the first currency. Let me define each clearly. In American terms, we quote number of USD per 1 unit of foreign currency. USD is the price currency. It is what you pay. The foreign currency is the base currency. So for example, if we take GBP and USD, then in this case with reference to American terms, GBP will be considered as a base while USD is the price. So GBP by USD is equal to 1.272. 1 British pound cost 1.272 US dollars. If we take Euro and USD, then Euro by USD is equal to 1.085. So 1 Euro cost 1.085 US dollars. Notice that in American terms it is the foreign currency, not the dollar, which is the base currency, and it is fixed at 1 unit. You are asking how many dollars does one foreign currency unit cost? In European terms, USD is the base. We always ask the number of foreign currency units per USD dollar. Here USD is the base and it is fixed at 1 unit, and foreign currency is the price currency. Hence, foreign currency becomes the price currency. For example, USD by INR is equal to 84.50, where 1 US dollar cost 84.50 Indian rupees. And USD by Japanese yen is equal to 149.80, where 1 US dollar cost 149.80 Japanese yen. Every currency in the world except Euro, Pound, Australian dollar, New Zealand dollar is quoted in European terms against the dollar. These countries historically viewed their own currency as the stronger or primary currency, so they prefer to place it in the first place in the quotation. Hence, old market practice is still followed in respect of these currencies. American terms and European terms for the same pair are simply mathematical inverse. If Euro by USD is 1.085 in American terms, then in European terms it is 1 divided by 1.085, which comes out to be $0.9217 per euro. Now we come to one of the most important concepts in all of forex trading, the bid and ask rate. And I want to start with a question. When you walk into a bank to buy or sell foreign currency, do you expect the bank to buy and sell at the same price? Think about it for a moment. Of course not. The bank is the business. It needs to make a profit on every transaction. The way it does this is by quoting two different prices simultaneously. One price at which it will buy from you and a different higher price at which it will sell to you. The difference between the two prices is the bank's profit. The difference is called the spread. Now let's see this. This is the bid rate. This is the rate at which bank or any other forex dealer is willing to buy the base currency, and ask price at which the bank or any other forex dealer is willing to sell the base currency. That means, suppose if you want to sell dollar, then the bank will buy dollars. In that case, which rate is going to be used? This bid rate will be used. And if you want to buy dollars, then bank will sell dollars. Then the rate used will be this one, which is the ask rate. Now, ask rate will always be greater than the bid rate because banks made profit on every transactions. Whether it is buying dollar or it is selling dollar, it has to make profit. So here what happens is that the difference between ask rate minus bid rate is the spread, and this spread is the profit margin of banks. Let me now give you a complete two-way quote and walk through it in detail. Here is the standard bank quote. USD INR is equal to 84.25 by 84.50. This is called two-way quote. The bank is simultaneously stating both the bid rate at which it will buy and the rate at which it will sell. No negotiation required. You see the two numbers, you decide whether to transact. You transact immediately. The bid is equal to 84.25. This is the left number. Always the lower one. What does it mean? The bank will buy USD at 84.25 rupees per dollar. If you are a customer coming to sell USD dollars, you are surrendering dollars to the bank. The bank pays you 84.25 rupees per dollar. So, if you are an Indian exporter who just received a dollar payment from an American customer and you bring those dollars to the bank buys your dollars at 84.25. You receive 84.25 rupees for every dollar you surrender. The ask rate here is 84.50. This is the right number, always the higher one. What does it mean? The bank will sell USD at 84.50 rupees per dollar. If you are a customer wanting to buy US dollar, you are paying rupees to receive dollar. The bank charges you 84.50 rupees per dollar, and if you are an Indian importer who needs to pay a US supplier, you come to bank to buy dollars. The bank sells you dollars at 84.50. You pay 84.50 per dollar you receive, and the spread is equal to 84.50 minus 84.25, which is equal to 0.25 rupees per dollar. Every single dollar the bank intermediary buying from exporter at 84.25 and selling to importer at 84.50, the bank earns 25 paisa. When you multiply 25 paisa per dollar across the millions of dollars that flow through a major bank in a single day, you begin to understand why forex trading is enormously profitable business for banks. The percentage spread is equal to 0.25 divided by 84.50 times into 100, which is 0.296%, approximately 3%, small as a percentage, but large in absolute terms at scale. Why banks use two-way quotations, that is, both a bid rate and a ask rate? The first reason is convenience. When a bank gives a two-way quote, the customer can transact immediately without entering into separate bargaining or negotiation. This makes the foreign exchange market faster, smoother, and more efficient for both the bank and the customer. The second reason is that the two-way quote clearly shows the bank spread, which is the difference between the buying rate and the selling rate. The spread represents the bank's margin for providing liquidity, bearing risk, and covering transaction cost. So, a two-way quotations improve both market efficiency and price transparency. In the above example, you can see that bid is lower than ask. The final rule to remember is very important. Bid is always lower than ask. In other words, a customer cannot buy a currency at a lower rate than the rate at which the bank is willing to buy it back. That difference is the dealer's margin and compensation for providing the quote. Now let us understand it with an example of two-way quotation. Now we have a quotation in which the bank is quoting USD by INR, where 83.85 is the bid rate and 84.15 is the ask rate. So what happens is, in the bid rate, what does it signify? Which is here 83.85, fine, which is equal to, I should say, is 83.85. That means bank buys USD at 83.85, right? And now we have the ask rate. This ask rate is equal to 84.15. Now what does it signify? That bank sells USD at 84.15. Now let us determine the spread. The spread is equal to 84.15 minus 83.85, which is equal to 0.30 rupees per USD. Now if we have to calculate the percentage spread, then it is equal to ask rate minus bid rate divided by ask rate into 100. So here in this case it is 0.30, because this is actually the spread. So 0.30 rupees per USD dollar divided by 84.15, which is the ask rate, into 100. So that means the spread is equal to 0.356%. Why spreads sometimes become wide? The first reason is low liquidity or thin market. When there are fewer buyers and sellers, it becomes harder for dealers to offset positions quickly, so they keep a larger spread for protection. The second reason is high volatility. When exchange rates move sharply, banks face greater price risk, so they widen the spread to protect themselves from sudden losses. The third reason is small transaction size. Small trade often involve relatively higher processing cost per unit, so dealers quote a wider margin. Finally, high information asymmetry also increases spread. If the dealer feels that the counterparty may have better market information, the bank widens the spread to guard against adverse selection risk. Now let us look at the factors that cause narrow spreads. High liquidity or deep market reduces the spread because there are many buyers and sellers, so dealers can offset positions very easily. Second, during low volatility period, exchange rates are more stable, so the dealer faces less risk and does not need a large margin. Third, the transaction volumes often receive tighter quotes because the cost per unit is lower and the business is more valuable for the dealer. Finally, electronic or algorithmic markets also reduce spreads because trading is faster, more competitive, and more transparent. So, narrow spreads are generally associated with low risk, high liquidity, and efficient market structure. Now, what is the mid rate? The mid rate is also called the mid market rate. The mid rate is the midpoint between the bid rate and the ask rate. So it gives a fair central indications on currency value at a particular moment. That is why it is often treated as a benchmark rate in foreign exchange markets. Mathematically, the bid rate is calculated as the bid rate plus ask rate divided by 2. For example, if the bid rate is 84.25 and the ask rate is 84.50, then the mid rate will be 84.375. It is important to remember that the mid rate is mainly a reference point to determine spread, and from there we eventually determine the bid rate and ask rate. Actually, customer usually transact at bid rate or ask rate, not at the mid rate. One practical use of mid rate in accounting and financial reporting. Companies often use the mid rate to translate foreign currency balances into reporting currency for financial statements. The reason is that the mid rate provides a neutral benchmark between the bid and the ask rates, so it is considered a fair representative market value. In accounting standards such as IFRS or IAS 21 and also under ASC 830, firm translate foreign currency item using exchange rate that reasonably approximate the actual market rate. In practice, the mid rate is often used for this purpose because it avoids the bias of choosing only the bid side or only the ask side. Another important use of mid rate, which is benchmarking spreads. The mid rate acts as a neutral market reference point. When we compare the actual rate given to the client with the mid rate, we can see how much margin or spread the dealer has added. This helps us identify the dealer's pricing margin more clearly. That is why the mid rate is important for transparency in foreign exchange markets. In simple terms, the farther the client rate is from the mid rate, the larger is the dealer's margin. One of the best known benchmark rates is WM by Reuters 4 pm London fix. This fix publishes a representative mid market rate that is widely used by index providers, asset managers, and institutional investors around the world. The reason it is most important is that many international portfolios, benchmarks, and fund valuations need a common reference rate for consistency. So, in practice, the mid rate is not only a theoretical average between bid and ask, it is also used as a major benchmark in global finance. Now, let us move to a different dimension of exchange rate quotations, how this works in real world. Now we shift from the theory of exchange rate quotations to the structure of the forex market itself, and specifically to different rate tiers that exist within that structure. This is extremely important for any financial professional. The first tier, the wholesale professional tier, is the interbank rate. The interbank rate is the rate at which banks trade foreign currency amongst themselves. It is not available to ordinary customers, it is not available to importers, exporters, or retail businesses. It is the exclusive domain of authorized dealer banks, banks that the RBI has licensed to deal in foreign exchange. Why do banks need to trade with each other? because no single bank can always have the exact foreign currency that its customer needed at the exactly the right moment. Now, the crucial characteristics of interbank rates, that is, the spreads are extremely tight. A typical interbank quote might look like USD INR 84.48 by 84.52, where a spread is just of 4 paisa on an 84 rupee base. This is a spread of just 4 paisa on a 84.52 rupees base. This is approximately 0.05%, which is incredibly tight. Why so tight? Because banks are dealing in enormous volumes, millions of dollars per transactions, and the counterparties are sophisticated professionals with real-time access to global price information. Competition is fierce, information is symmetric, and profits come from volume rather than margin. If my bank's customers are heavy importers today, I need to buy a lot of dollars. I go to the interbank market and buy from other banks that have surplus dollars. The interbank market is where the wholesale balancing happens. In India, interbank forex trading is conducted on the Forex Clear platform operating by CCIL, that is the Clearing Corporation of India Limited. It is fully electronic, fully transparent, and fully audited. Every interbank deal is recorded. The RBI reference rate are published daily at 1:30 p.m. This is essentially the midpoint of the interbank transactions at that moment. It is called as an average of rates traded in the interbank market just before 1:30 p.m. This reference rate then becomes the benchmark for everything else in the Indian forex market. So let us talk about this interbank forex quotations with help of an example. Now let's see this question. In this question, we have been given quotations of different currency pairs. And here we have the currency pairs are GBP by USD. We have been given bid and ask rate for this pair. Now let us do the question. And here the company wants to buy or sell USD as a base rate, then which rate it should be able to do so. That means the company can do either of the two or wants to do both. It wants to buy also or sell also. Then which rate we are going to take as ask rate and bid rate. So let us do this question here. GBP is the base currency. And let us assume that company wants USD, right? It wants to buy USD. So what we should do? We have been given, we will invert GBP USD quote to get USD GBP quote. Now how we will do it? So we have this GBP USD which is given to us, right? And we have to calculate USD GBP. So we have been given the bid rate which is 1.62536. We have been given ask rate which is 1.62576. Now what is the rule? Very important thing, that what is the rule? The rule is for inversion. The rule for inversion. Inversion. So first what we have to do is swap the ask, bid and ask. right? And second point is that we have to find the reciprocal. So here what we will do is, first we will swap and find the reciprocal. So here the reciprocal will not be 1 upon 1.62536, it's going to be 1.62576. So we have 1.62576. This gives us 0.61509. And now here the reciprocal will be of the bid swapped to the ask, and this is 1.62536, which gives us 0.61524. So if we are talking about the USD GBP pair, then the bid rate is going to be this for USD GBP, and the ask rate is going to be this for USD GBP. So we first swap and reciprocate. Now here let's calculate the bid ask spread. And in the bid ask rate there are two things. One is the dealer's profit and the other is the company's cost. Now forex dealer always buys low bid and sells high ask. High means low and sells high. While for the company, it gets the worst rate. It buy at ask and sells at bid. And this spread is the transaction cost for the company, while the spread is the profit margin for the bank or the forex dealer. Now let us do the spread calculation. The spread calculation in case of GBP USD is 1.62576 minus 1.62536 divided by 1.62536 into 100, which gives us 0.0246%. We have already established that the interbank market is where banks trade foreign currency with each other. But let us now go on deeper level. Why do banks need to trade with each other at all? The answer lies in inventory management. Think of a bank as a shop that deals in foreign currency all day long. Every time an exporter walks in and surrenders dollar, the bank's dollar inventory increases. Every time an importer walks in and demands dollar, the bank's dollar inventory decreases. These two flows almost never perfectly cancel each other out in real time. So, at any given moment, a bank either has too many dollars, a surplus, or too few, a shortage. This is the problem that the interbank market exists to solve. If a bank finds itself with excess foreign currency, more dollars than it needed, it goes to the interbank market and sells those surplus dollars to other banks. It does not want to hold too much foreign currency because that creates directional exchange rate risk. If the dollar falls in value tonight, the bank's dollars inventory loses rupees value. So the bank offloads the excess quickly. Conversely, if a bank faces a shortage, its customers are demanding more dollars than the bank currency, it goes into the interbank market and buys dollars from banks that have surplus. This two-way flow is continuous, happening hundreds of times per day across the system. The result of all this continuous buying and selling is that each bank stays close to a neutral inventory position, neither excessively long nor excessively short in any currency. But there is an even more sophisticated layer, that is quote adjustment. A bank does not just go to the interbank market to fix its inventory, it also adjusts the rates it quotes to its own customer to nudge its inventory in the right direction. Here is how it works. If the bank is surplus in dollars, it will lower its bid rate slightly. A lower bid rate discourages exporters from bringing more dollars to the bank. At the same time, it lowers the ask rate to make dollars slightly cheaper for importers, encouraging them to buy more dollars away from the bank. Both adjustments together reduce the bank's position. Conversely, when the bank is short, it has few dollars. It raises the bid to attract more dollar seller and raises the ask to slow down importer demand. Together, these adjustments help the bank rebuild its dollar inventory without having to go to the interbank market every single time. The ultimate purpose of all this is risk reduction. A bank that maintains a neutral currency inventory carries minimal directional exchange rate risk. It also satisfies RBI regulatory requirements for authorized dealers, which set limits on open foreign currency position a bank can hold overnight. Inventory management is therefore not just for commercial necessity, it is a compliance requirement. Now let us understand that how the bank changes its inventory by changing the quotations. Let us say the GBP USD quotation earlier was 1.62536 for bid rate and 1.62576 for ask rate. Now suppose the bank wants to increase its USD inventory, it will increase its bid rate and it will also increase its ask rate. Now, how the inventory is going to be increased? When bank increases bid rate, then the exporter is encouraged to sell. Sell what? Dollars. But when bank reduces bid rate, then the exporter is discouraged to sell. Similarly, the reverse is the case for the importer. Now let us take the case 1. They want to increase the USD inventory, needs to be increased. Then bank increases bid rate, encouraging exporter to sell, because bid rate is the rate at which the bank will buy. And at the same time, bank is increasing ask rate to discourage importer to buy dollars. So there will be more selling than buying of dollars, which will increase USD inventory in the bank. Now let us move to the corporate exchange rate. In India, merchant rate is the formal regulatory category for all banks to customer forex transactions. Corporate rate is a market practice outcomes within that category where large sophisticated clients negotiate a smaller exchange margin due to volume, relationship value and pricing power. However, both are same. Let me ask you this: who will get a better exchange rate from bank? A tourist buying $1,000 or a company regularly buying $5 million for import? Obviously, the company. Now, why? Because the company brings larger business volume and it allows corporates to negotiate tighter spreads. The bank notes that even a small spread on a very large volume can still generate good revenue. Individual customers receive the least favorable exchange rate in foreign exchange as compared to rates offered to corporate customers and interbank rate. The main reason is that the retail transactions are small in size, but the bank still must incur processing and service cost. In addition, banks must meet regulatory requirements such as KYC and AML compliance, which increase the cost of handling these transactions. Because of lower volumes, higher operating costs per transactions, and the need to earn a profit margin, banks apply wider spreads to retail customer. That is why tourists, students, and small remittance customers usually get weaker exchange rate than corporates or interbank participants. What are the main service channels through which retail customers access foreign exchange? These include bank branches, airport kiosks, mobile wallet, and digital remittance platforms such as Wise and Paytm, and specialized forex dealers. Although these channels serve retail clients, the clients of the exchange rate offers can differ across them. For example, airport kiosks usually charge the widest spread because convenience is high and competition is limited, while digital platforms may sometimes offer relatively better rates because their operating costs are lower. So, the retail exchange rate depends not only on the customer type but also on the service channel through which the transaction takes place. Now, we can see here that the interbank spread is just 40, then it has increased to 94 for corporates, and then more wider for retail customers. Let me close with a brief synthesis of what we have covered today. We started with the most basic question: how do you express the price of one currency in terms of another? That gave us direct and indirect quotations, American and European terms. We then introduced the bank's perspective, the bid ask spread, the two-way quote, and the spread as the bank's profit mechanism. And finally, we built the complete rate architecture of Indian foreign market. That's all for now. See you in the next lecture. Thank you.